Welcome back, traders and investors, to the introduction of the Supply and Demand Trading Strategy, Forex Market and Bonds Module 1b. In the Forex market, the currency supply is determined by the country's central bank that issues that currency and other factors such as international trade and investment flows. The demand for a currency is determined by the willingness of investors to hold that currency, as well as international trade and investment flows. When demand for a currency is high, its price relative to other currencies will increase, and when demand is low, its price will decrease. Let's consider the euro-US dollar currency pair, one of the Forex market's most widely traded currency pairs, and evaluate several factors that could influence supply and demand. Economic data releases such as gross domestic product, GDP, inflation, employment figures, and consumer spending can influence the supply and demand for the euro-US dollar pair. If economic data is better than expected, this may lead to increased demand for the euro and, therefore, a rise in the euro-US dollar exchange rate. Conversely, if economic data is worse than expected, this may lead to decreased demand for the euro and a fall in the euro-US dollar exchange rate. The European Central Bank, ECB, and the U.S. Federal Reserve, Fed, are responsible for setting monetary policy for their respective currencies. Changes in interest rates, quantitative easing programs, and other policy decisions can affect the supply and demand for the euro-US dollar pair. For example, suppose the ECB raises interest rates or implements a hawkish monetary policy. In that case, this may increase demand for the euro, increasing the euro-US dollar exchange rate. Political events such as elections, geopolitical tensions, and trade disputes can affect the supply and demand for the euro-US dollar pair. For example, political uncertainty or instability in Europe may lead to decreased demand for the euro and a fall in the euro-US dollar exchange rate. Similarly, a trade dispute between the US and Europe may lead to reduced demand for the euro and a fall in the euro-US dollar exchange rate. Market sentiment, which refers to the overall mood or attitude of traders and investors towards a particular currency, can also affect the supply and demand for the euro-US dollar pair. For example, suppose investors are optimistic about the Eurozone economy and believe that the euro is undervalued. In that case, this may lead to increased demand for the euro and a rise in the euro-US dollar exchange rate. Technical analysis. Technical analysis involves studying historical price and volume data to identify trends and patterns, which can also influence the supply and demand for the euro-US dollar pair. Traders who use technical analysis may look for signals or patterns that suggest whether the exchange rate is likely to rise or fall and adjust their trading positions accordingly, which can affect the supply and demand for the currency pair. The euro-US dollar pair has retreated from 1.10860, fallen below the 1.098 and 1.094 demand zone as of 13 May 2023, and is headed to 1.0838 and 1.080. The majority of significant moves in its price on the chart are related to some of the several factors mentioned earlier. This price movement is often seen around the supply and demand zone on the price chart. The euro-US dollar's past, current and future supply and demand zones based on the historical data are indicated on the chart. The supply and demand system calculates and adjusts the zones when necessary and keeps the system up to date. In the bond market, the supply of bonds is determined by the issuer, whether it is a government or a corporation. The demand for bonds is determined by the willingness of investors to purchase those bonds. When there is high demand for bonds, their price will increase. When demand is low, their price will decrease. The most influential bond in the U.S. market is generally considered the 10-year U.S. Treasury bond, which is issued by the U.S. government and has a maturity of 10 years. The 10-year Treasury bond is widely used as a benchmark for interest rates in the U.S. and is closely watched by investors, economists, and policymakers. The supply and demand for the 10-year Treasury bond, like any other bond, is influenced by a variety of factors, including the following. Economic data releases such as GDP, inflation, and employment figures can influence the supply and demand for the 10-year Treasury bond. If economic data is more robust than expected, this may lead to an increase in the demand for the bond and, therefore, a decrease in its yield and an increase in its price. Conversely, weaker than expected economic data may lead to a decrease in demand for the bond and an increase in its yield. The actions and statements of the U.S. Federal Reserve, which is responsible for setting monetary policy in the U.S., can affect the supply and demand for the 10-year Treasury bond. For example, if the Fed raises interest rates or indicates that it will do so in the future, this may lead to an increase in the yield on the bond as investors demand higher returns. Political events such as elections, geopolitical tensions, and changes in government policy can also affect the supply and demand for the 10-year Treasury bond. For example, suppose there is uncertainty or instability in the U.S. or global political environment. In that case, this may lead to an increase in demand for the bond as investors seek a safe haven for their funds. Market sentiment, which refers to the overall mood or attitude of investors towards a particular asset, can also influence the supply and demand for the 10-year Treasury bond. For example, if investors are optimistic about the U.S. economy and believe that inflation will remain low, this may lead to an increase in demand for the bond and a decrease in its yield. Finally, supply factors such as the amount of new Treasury bond issuance, changes in regulations governing bond issuance, and changes in investor preferences can also influence the supply and demand for the 10-year Treasury bond. For example, if the U.S. government increases the amount of Treasury bonds it issues, this may lead to an increase in supply and a decrease in the price of the bonds. The price of the 10-year Treasury bond has been decreasing since October 2022, and as of May 12, 2023, it was last traded at 3.47%. The drop in price could be influenced by the various factors mentioned earlier, such as economic data, monetary policy, political events, market sentiment, and supply factors. The price range for the 10-year Treasury bond as of 12 May 2023 is around 3.62 and 3.30, and there is an anticipation of either a breach to the upside at 3.62 or a drop below 3.30. It is important to note that the price of the 10-year Treasury bond can be volatile and subject to change based on various market factors. The supply and demand system is a reliable tool you can count on. Combined with the momentum indicators, it will provide a clear and reliable direction based on price action. The next module, 1C, will cover the futures market and cryptocurrencies.